Okay, so good morning, everybody. So today we are going to do the chapter 4 of the lecture notes, okay? That is the general introduction concerning finance in continuous time. So you will see that we won't do too much math, okay, in this chapter, okay? It was just a general presentation to be able to work with the Black-Scholes model in the chapter I will start after the holidays. Okay, so let's go. Okay, so first of all, okay, I will try to convince you that, okay, why we have done, okay, during the 3 first months, okay, why we have done mathematics, okay, to speak about, okay, finance together, okay. And I will try to convince you that in fact, the stochastic integral, the one we have built in the chapter 2, in fact, appears very naturally, okay, in trading problems. Okay, so let's see this little example. Okay, so let's do this. Okay, so let's suppose that you have a financial asset, whatever this asset is. Okay, and we are going to do a very bad hypothesis, that is the value at time t is but simply the value of the Brand motion at time t. Okay, so I have something, so I have a financial asset, okay, with an evolution that is for me at time t equal to 0, something that is random. Okay, I don't know what will be the value of my asset at time t, and I represent value, okay, by the Brand motion at time t. So why I say that it is a very bad hypothesis? It's a very bad hypothesis because, okay, BT can take strictly negative values, so something that is not that correct, okay, for a price, okay, but whatever, okay, it's the very beginning of the introduction, okay, so why not? And in fact, it was exactly the hypothesis, okay, of one very important work in mathematical finance, that is the work of Bachelier at the beginning of the 20th century, okay, that do exactly this hypothesis, okay, to model some particular financial market. Okay, and you have in the lecture notes, okay, some historical aspect, okay, of this seminal work. Okay, so if I suppose this, okay, and I suppose that I have, so trading times, okay, so I have a time interval, 0 capital T, with some, okay, trading dates. So I have T1, that is T equal to 0. I have T2, T3, until Tn, that is equal to capital T. Okay, so I have here n trading dates. It will be dates where the trader will take the decision to buy or sell something, not between, but only at these dates. Okay. So we are going to suppose the following strategy for the trader. Okay, so for any time here, Ti belonging to the trading dates here, I suppose that the trader buys at time Ti, okay, a quantity that is FTI assets, okay, at the time Ti. And with a price for each one, okay, each unit that is given by BTI, okay? And F is simply a mapping, so something that is deterministic, okay, from 0 capital T into R. Okay, so it may be positive, negative, whatever. Okay, it's just the quantity he buys at time ti. And I suppose that you are at T1. Okay, so at T1 I buy FT1 asset. Okay, and what I will do the date after is to sell the quantity I have bought at the preceding date. Okay, so I will sell them at the price that has changed for sure, that is BTI plus 1. And I said that during the period TI plus 1, what is the profit made by the trader? It's just the quantity I have bought at time TI multiplied by the variation of the price, that is BTI plus 1 minus BTI. Okay, so the profit of the trader on the trading interval TI plus 1 is given by this quantity. Okay, so since I have n minus 1 trading intervals, if I want to have the total profit of the trader, I have just to do the sum of what I do over each trading interval. Okay, and so I obtain for the total profit of the trader, okay, this quantity here. And what is nice with this quantity is that if I suppose, okay, so let's suppose that my dates, okay, are regularly spaced, okay, and that I have here a step size between two dates, okay, that I will call delta that will goes to 0. Okay, so what happens when delta goes to 0, okay, in this situation? But in fact, we have seen this at the end of the chapter 1. Okay, it was one of the definition of the stochastic integral with respect to the Brownian motion. We have seen that when my step size goes to 0, this quantity is convergent and converge toward what? Converge to the stochastic integral between 0 and capital T of f with respect to the Brownian motion. So when the trading is done in continuous time, that is when the step size delta goes to 0, then the total profit of the trader, okay, becomes simply a stochastic integral. Okay, so here you have the intuitive interpretation of the stochastic integral as the total profit of a trader that trades in continuous time. Okay, so it's the first step. Second step. So we are going to see that in this course, we are going to be interested in what we call pricing and hedging problem. Okay, so if I come back to my financial asset here, with value at time t that is given by bt. So I have here the set of the values that is given by this one here. Let's be interested in a call option of strike K and maturity capital T on this asset. So I will come back on this point later on, but you know that, okay, so I consider a European call option. So what is the principle of this classical financial product? Okay, it's that, okay, it will give you the right, but not the obligation to obtain, okay, one quantity of the financial asset at time capital T at the price K that is fixed at time T equal to 0. Okay, so you have the right, but not the obligation. So it's an optional product. Okay, you have the right to exercise it or not to obtain 1 unit of the financial asset at time capital T at the price K. And we know that this financial product, it's perfectly characterized by what happened at capital T, because here I can only take my decision to buy or not my financial asset at capital T, okay, at the date capital T. So the payoff in this situation is given by this quantity. And let's take the point of view of the seller of such an option. Okay. Excuse me. So if I have not the seller point of view, what I do? Okay, so we are going to plot here the total profit of the seller of such an option. So first of all, okay, so I will have something that will depend on, okay, the value, or that is here B, capital T. And here I have my profit. Okay, so when you are the seller of such product, okay, you sell a right. That is, okay, you sell to your customer, to your client, okay, the possibility to do something. So it has a price to do. Okay, so you will have something at time t equal to 0. So at time t equal to 0, okay, I obtain a price, small k. I don't know for the moment how this price is fixed. So price k at time t equal to 0. So you ask for this price, okay? And we are going to see what happened for your total profit, okay, when you do this. If you do this, okay, what happens? So if you are, okay, at capital T less than K, it means that you have the right at capital T to buy at the price K something that is cheaper. And of course, you won't exercise your product. So if you are the owner of this product, if B capital T is less than K, you won't exercise. So it means that I don't exercise this product when I am the owner. So something that is perfect for the seller. So what will the seller do in this case? But it will have the price. So I start with the price here, and until K, I have this. So I am for the seller in the perfect situation where you have sold something that the client won't use. Okay, so you have the price and then nothing because the client or the owner of this financial product won't exercise its right. And then what happens? So if I am, so B capital T is greater than K, the owner of such a product will start to exercise. Okay. And what is, okay, what you will have to pay in this situation? I will have to pay K minus BT. So I have a profit for the seller that is something like this, where here you have a quantity that is equal to what? That is equal to, so it is K plus small k here that you have here. And it means that from the seller point of view, you are here in a very dangerous area, because if B capital T increase too much, even if you have asked for a good price at time t equal to 0, you have some situation where when you are the seller of such a product, you have the possibility to lose a huge amount of money if B capital T becomes very, very high. Okay? And you will see that in finance, we are going to have two problems. That is first, how to fix this K here. That is the problem of the pricing. And how to overcome this situation here. That is a situation where potentially the seller of such a product will have to pay a huge amount of money at capital T if, in my situation here, B capital T increases too much. Okay, so in some sense, I want to, if possible, to reduce as possible, okay, the risk due to, okay, this area. Okay. And when, in fact, if I come back to my previous situation with my trader that sell, okay, buy and sell, okay, quantities at trading dates, okay, I can see the following. So to fix the ID here, the P capital T I would consider is my corresponding call option here to fix the things. So suppose that the payoff of the product we are interested in here may be written this way. So what is the intuition below this equality? It means that if you have a trader that starts from small k, if he does the strategy small f as explained in the previous slide, okay, here you have the value at capital T of his strategy, and the value of his strategy is exactly the payoff of the option I am interested in. And in fact, what we are going to try to do rigorously in the next slide, okay, is to try to convince you that if I am in such a situation, okay, in good financial markets that are the ones that fulfill the no arbitrage hypothesis, I will enter into details later on, necessarily the price at time t equal to 0 of such a product is given by the constant k. And if you are able to do the strategy small f, you reduce the risk that is relative to the sale of such a product to 0 because, okay, if you ask for k at time t equal to 0, you can use it to do the strategy f in order to reproduce at the end exactly the payoff that the seller has to deliver at capital T. Okay? And you see that this kind of relation, making the link between this option and a stochastic integral plus a constant, okay, will be the fundamental link that will allow us to price such a product, but also to hedge it. Okay? So in this chapter, we are going just to introduce the basic notion concerning this problem, okay? And you will see that in the chapter 5, being in the Black-Scholes hypothesis for the modelization of the value of this financial asset, because I have already said that, okay, to take the brand motion here is not a good idea because I can take strictly negative values. I want a model that is a little bit more realistic, in particular a model that takes strictly positive values, okay? Exactly what happened in the case of the Black-Scholes model, where I consider a geometry Brownian motion. And we will see that, okay, in this case, okay, we are going to be able to check, okay, and to discuss what is this no arbitrage hypothesis here. And we are going to be able to find such equalities, okay, using, okay, some results that we have seen together in the chapter 3. The problem related to no arbitrage hypothesis will be linked to the Girsanov theorem, okay, and the problem that is how to obtain such an equality here will be relative to the martingale representation theorem. Okay? So I see that, okay, considering trading in continuous time, okay, and passing to the limit in the profit of a trader, I see naturally appear some objects that are related to the integrals we have defined previously. Okay? So let's start in more details what we are going to do. Okay, so we are going to model, okay, what will be the variations of financial assets across time, okay? And typically, what will be the value of an asset, okay, in the future is something that I don't know, so it's something that I can suppose to be random, okay? But if I want to define randomness, okay, the first thing I have to define, okay, is a probability space, okay? So if I come back to this slide here, so I want to model, okay, my financial market in continuous time. So first, I will give us a time square, okay, that is here simply the interval 0 capital T, where capital T will be the maturity of my financial product. So typically, if you have in mind a call or a put option, okay, it will be the maturity of these options, okay? And then I have my triple, my probability space here, okay, where omega is a set, calligraphic A is a sigma algebra, and capital T is a probability that is called the historical probability. So intuitively, what is this triple here? So omega, okay, will be the set of all the macroeconomic possible configuration during the time 0 capital T. Okay, that is, okay, the set of all the financial scenario during the considered period, okay? So it's something that in general, okay, you have, if you have a very good economist in a bank, okay, something that you are able to describe, let's say, that precisely, okay, what will be the set of the possible futures, okay, in terms of macroeconomic issues, okay? Calligraphic A is a sigma algebra. This sigma algebra, as I have said, okay, when I have remind the definition of sigma algebra, is something that in mathematics, okay, we relate to an information. For me, this calligraphic A here will represent all the financial information available during the period 0 capital T. So it means that typically when you are at time t equal to 0, it's not something that you know, okay? Because if you have the possibility to access all the information during the whole period here, but you will have the possibility to predict everything, okay? So in general, okay, calligraphic A will be chosen as a model, but something that is very difficult to extract from real data, okay? And capital P here is just, okay, a probability that we call the historical probability of the underlying real probability on the set of the macroeconomic configuration. And once again here, in general, okay, it's very, very difficult to have access to such a capital T, because first of all, you have to describe precisely all the scenario here, and then to be able to put, okay, a probability on them without knowing what will happen in the future. Okay, so in practice, calligraphic A and capital P are not available from financial data. Okay, but you will see that it's not that a problem, in fact. So I have said that for omega, if I have good economists, I am able to describe. For calligraphic A, I will take a model, okay, that is a classical sigma algebra. So for us in continuous time, okay, it will be, okay, possibly the Borel sigma algebra or something like this, okay? And the problem of P, so you will see, and typically you will see in the chapter 5 that it's not that a problem not to know capital T. Because in what I want to do, that is to price and to hedge financial products, in fact, I won't need to use this capital T. I will use to price and to hedge my financial products other probabilities, okay, that are equivalent to capital T, but okay, I will be able to know them perfectly without knowing capital T. Okay, so even if I don't know capital T in practice, you will see that it's not that a problem because I won't express, okay, pricing issues or hedging issues in terms of capital T. Okay, So I have a time square and a probability space here. Okay. So I have a time square and a probability space. What I am able to do, I am able to define, okay, stochastic processes that are just, okay, a family of random variable, okay, defined on my probability space that take into account the randomness of the things, okay, and indexed by my time square, okay? So in this course, I will consider the basic situation where I have, okay, simply two types of financial assets. We are going to consider what we call a non-risky asset. And I will consider one risky asset. Non-risky and risky. Non-risky, as I will explain in a few seconds, okay, will be the one that will allow us to actualize because it will be a kind of benchmark, okay, and that will be related to some interest rate, okay. And the risky one that will represent, okay, a stock, let's say, okay, or a commodity or anything you have in mind, okay. And by risky, I just mean, okay, something that is, okay, that may be represented a long time by a stochastic process. That is something that is random, something I'm not able to know at time t if I am at a time before small t, okay? So it should be possible to extend, okay, what I will do to the case of more than one, okay, but it's an introduction to finance in continuous time. So for this course, I will restrict myself to one, having in mind that it is totally possible to do the same for more than one risky, okay, without too much technical problems, okay? So for the non-risky assets, okay, so I suppose that during the period 0 capital T, it is possible to borrow and lend cash at a rate small r that is supposed to be constant. Okay, I have a constant rate that is fixed, okay, over the whole period. Okay, so before to go into the details of the definition of the non-risky asset, I just want to come back to some points concerning, okay, constant rate and the way to capitalize, okay, with this kind of rate. Okay, so I just pass to another document, okay, I have prepared, that is this one. Okay, so sorry for the fact that it's not that, excuse me, we'll do this. Okay. Okay, so suppose that you are in the following situation. Okay, so I have my time period, and I suppose that capital T is expressed in years. Why not? Okay, and I suppose that I have 365 days a year. And I suppose that there exists an interest rate, small r, that is constant. Okay, and I suppose it, so you know that if I want to speak about interest rate, okay, I need to do some hypothesis concerning the rules of computation of the interest. In fact. And here we are going to suppose that I have an annual rate, and it's exactly what I will do during the lectures now. So under this hypothesis that I have on the period 0 capital T an annual rate that is constant and equal to small r strictly positive, my question is, what is the value of €1 lent at time t equal to 0? Okay, so what is the capitalization process in this situation? And in fact, it's not possible to answer this question properly if you don't do extra hypotheses that you know. Okay, in fact, it depends on the convention concerning the composition of the rates that may be annual, semestrial, trimestrial, daily, or continuous, okay? during a year. So in order to explain to you what happened, okay, I have done this little picture here. So keep in mind that I have my annual rate, small r, supposed to be constant, okay? What is the meaning of an annual composition of this rate, okay, of this annual rate? It means the following. If I start from €1 at time t equal to 0, okay, if I have the annual composition of an annual rate, okay, then it means that you obtain simply after 1 year, 1 plus r. And so after 2 years, 1 plus r squared, and so on, okay, until capital T, because I have expressed capital T in years, okay, here. Okay, so it's the convention of an annual rate that is compound annually. If I have a semestrial composition, what is the meaning of this? It means that, okay, in fact, I will transform my rate small r into two rates of size r over 2 on each semester of a year. So it means that if I start from time t equal to 0, in order to compute the capitalization process here, I have first to see what happened after one semester, that is for t equal to 1/2, that is something here, okay? So for t equal to 1/2, I obtain 1 plus r over 2, okay? Because I cut my annual rate small r into two rates of size r over 2 on each semester. So I obtain 1 plus r over 2, and it means that, I am here, excuse me, it means that after 1 year, since I have 2 semesters here, I obtain 1 plus r over 2 squared. And then at capital T, I have 1 plus r over 2 multiplied by the number of semester in capital T years, that is just 2 times capital T, okay? With my daily convention, okay, I do exactly the same. It means that after 1 day, my euro is transformed into 1 plus r over 365, okay? And then after 1 year, that is after 365 days, I obtain this value, okay, for my initial €1. That becomes at the end, after capital T years, okay, 1 plus r over 365, okay, multiplied by the number of days in capital T years. That is exactly this quantity here. And of course, okay, I can generalize what I have done for an annual, a semestrial, or a daily composition. For the case of n period of composition a year. So if I do this, okay, it means that starting from my euro, okay, I divide my year into small n periods, okay, where I will apply a rate of r over n. So if I do this n time a year, I will obtain after 1 year 1 plus r over n to the power n, and then after capital T years, 1 plus r over n multiplied by the number of periods, okay, during the capital T years, okay? And the natural question is, what happened when I do the composition in continuous time? That is, what happened when, okay, the number of periods goes to plus infinity, okay, a year. And of course, by a classical result, you can see that this quantity here, when n goes to plus infinity, converges toward exponential r, and this one converges toward exponential r capital T. So it means that if I do my convention of continuous composition for the annual rate, okay, then the value at small t of €1 capitalized at time t equal to 0 is equal to exponential RT, okay? So let's come back to my whiteboard here. So it's exactly what we are going to do. In fact, here, I suppose that this constant rate is an annual one, okay? And I will suppose that I do a continuous composition. And in fact, what I will call the non-risky asset will just be an asset whose value at time t is denoted by S0t. So the 0 here means the non-risky, okay? And it is the value of €1, so the value at time t of €1 that I have capitalized between 0 and small t. And so S0t, according to what I have reminded in my previous slide, okay, is equal to exponential RT, okay? And I call this asset non-risky because, okay, when you are at time t equal to 0, you are sure of what will be the value of this asset at small t. It will be exponential RT, something that is deterministic, okay? And the aim of this non-risky asset will be to have in mind that the value of €1 today, or €1 yesterday, or €1 tomorrow is not the same, okay? And in particular, we introduce the following notation. If I have a quantity xt lying at time small t, I will consider its actualized value, okay? So xt tilde in the remaining of these lecture notes, okay, will be the actualized value of a quantity xt, okay, that lies at small t, and that is equal, it's exactly what I have written here, okay, the value over the value of the non-risky asset at time t, okay? So I will use, in fact, mainly non-risky asset, okay, in actualization processes, okay? And keep in mind that in my course here, I suppose the rate to be constant, and so my non-risky asset is purely deterministic, okay? So this asset is purely deterministic, okay? In the next semester, you will see with Etienne Keller that, okay, it is possible to model this constant rate, okay, in a deeper way. But as my course is an introduction, I will restrict myself to the case of a constant annual rate, small r, that is compound continuously. Second type of asset here. The risky one. So here, okay, from an intuitive point of view, asset may be, okay, anything you have in mind. It can be a stock, okay, that is the ownership of a small part of a company. It may be a commodity, okay, so it may be anything you want. The only thing that I will suppose here is that, okay, when I am today, I am not able to predict what will be the value of this asset in the future. So I suppose that the value of this asset in the future is a random variable. And since there is an evolution of this value a long time, okay, I will represent the value of this risky asset as a stochastic process, not a deterministic one, a stochastic one, okay? And I denote by S small t, the value of this asset at time small t that I won't know until small t, okay? So before small t, I am not able, so strictly before small t, I am not able to say what will be ST. I am just able to say that it is a random variable. We are going to discuss the distribution later. Okay. So ST is just the stochastic process, okay, that is related to the random value of, okay, a financial asset. As usual, okay, and as introduced in the chapter 0, this is adapted to its natural filtration. So you have here, okay, as I have explained in the chapter 0, the filtration that is generated by this process here, okay? And I know that ST is adapted with respect to FT, okay? And what is more, keep in mind that at the very beginning, I have introduced calligraphic A, that was my big sigma algebra, let's say, that was the financial information over the whole period. And thanks to my filtration here, that is an increasing family of sigma algebra here, I have here what I can call the financial information at time small t, something that becomes bigger and bigger with time, okay? And the hypothesis I will do concerning this stochastic process is that, so I suppose it to be adapted to the natural filtration, and we are going to suppose it to be continuous. That is, okay, we have continuous trajectories. And keep in mind that you know that when you are adapted and continuous, you are progressively measurable. Okay? Adapted and continuous in the chapter 0 implies progressively measurable. Okay? And I have already said that FT represents the financial information available at time t, okay? And the very general hypothesis I will do in this chapter, and I won't enter into more details concerning this point in the chapter. I will keep this question open for the chapter 5, okay? I will just suppose that the dynamic of my risky assets is an adapted and continuous process whose dynamic is given by an Ito process, okay? So I suppose that ST belongs to the family of the Ito processes without for the moment precising what will be the underlying Ito process, okay? And I suppose it constant at time t equal to 0, something that is natural because, okay, when I am today, I am able to say what is the value of my asset today, what is the value of my asset now, okay? So in particular, supposing that my process is constant at time t equal to 0, and this one implies that the initial financial information is equal to the trivial sigma algebra here. And keep in mind that for this sigma algebra, F0 measurable just means constant, okay? So when I will consider, okay, processes adapted to this financial filtration, okay, at time t equal to 0, all the values will be constant, okay, in order to represent the fact that when I am at time t equal to 0, I am able to know the values of the asset at time t equal to 0, something that is that natural. Okay, so I have one non-risky asset with a dynamic that is purely deterministic, okay, and a non-risky asset with a dynamic here at this stage that is very, very general. I just suppose it to be, okay, continuous and adapted, of course, to its natural filtration. I have a stochastic process this way, okay. This natural filtration will just be the financial information available at time t. And my hypothesis is that I will suppose that my risky assets dynamics, okay, is given by an Ito process constant at time t equal to 0, okay? And I repeat that at this stage and during the chapter 4, I won't precise what will be the underlying Ito process. In the chapter 5, okay, we are going to see that in the case of the Black-Scholes model, the related Ito process is just simply the geometric Brownian motion. But it can be at this stage, say, something that is more and more general. Okay, so we have two assets. What can we do? If I have assets, I can buy them or I can sell them, okay? In order to make them possible, okay, what we call financial strategies or trading strategies, okay? So before to define what will be for us a financial strategy, so something that is related with these two types of assets, okay, I will start with, okay, some hypotheses that we are going to do, okay, for the end of this course. So it's not this one, it's this one. Okay, so I have my two assets and we are going to do the following hypothesis. So I prefer to start with this following hypothesis before to introduce the next definition, that is the definition of what is a financial strategy. If I give you this definition now, you will find it very natural, okay? But in fact, of course, it is natural, but you have to keep in mind that to make it natural, I have a set of hypotheses on the market that are all these ones, okay? Suppose that I don't have frictions on my market represented by the non-risky and the risky assets. And what is the meaning of this? So first of all, because it is my framework, okay, I suppose that the trading is done in continuous time. It is a real hypothesis because, okay, in reality, even if we have computers, okay, in reality, we have a very small amount of time, okay, between two financial decisions that may be very, very short, okay, but this time exists, even if we have very powerful computers. But as an hypothesis, okay, I suppose that it is possible to trade in continuous time. That is, it's possible to sell or to buy at any time without any problem, okay? So just keep in mind for the one that I follow my course of arbitrage, it is very different from what I have done in the course of arbitrage theory that was in discrete time. But of course, there is a link between continuous and discrete time, okay? In general, when I pass to the limit in the discrete times, okay, I can recover partly, okay, the result obtained in continuous time. But continuous time, the interest of the continuous time is that, okay, we are going to be able to use all the mathematics we have introduced in the previous chapter. Okay, so I suppose that the trading is done in continuous time. I suppose that there are no transaction costs nor taxes. In general, you know that if you want to buy or sell an asset, and typically the risky asset, you need first to enter the market. So it means that you need to pay someone to have the possibility to do. And then if you buy or sell some quantity of asset, okay, you will need to pay what we call transaction cost, okay? That is a little fee in order to be able to do transactions, okay? So suppose that in the following, I have no transaction cost nor taxes, okay? I also suppose that the risky asset won't pay any dividend, okay? So you know that in general, okay, when you own a small piece of a company or a financial product, more generally, if you keep it a long time, okay, to be rewarded of your fidelity in some sense, okay, if the firm or the product does good performances, okay, you will obtain a little amount of these good performances called a dividend, okay? I suppose in my situation that my risky asset won't pay any dividends, okay? Other hypothesis, I suppose that all the assets are perfectly divisible. Okay, what is the meaning of this one? But it means that you can buy or sell, okay, any quantity you want that may be, okay, not necessarily, okay, a natural number. In general, okay, you can buy 1, 2, 3, 4, 5, and so on assets. Here, I suppose that you will have the possibility to buy, for example, 1/2 of the risky asset, okay, or 1/2 of the non-risky asset. So for the non-risky asset, it's not that surprising because it is related to an annual rate, okay? So you borrow or lend something to a bank, okay? So you can borrow or lend a priori the quantity you want. For the risky asset, it's a little bit more surprising because in general, okay, you can only, okay, buy or sell natural number quantities, But here I suppose that, okay, 1/2 or 100 is allowed, okay? And what is the intuitive meaning of this one? Okay, it's just that, okay, instead of reasoning in terms of quantities, I do the reasoning in terms of values, okay? What is 1/2 of the risky asset? It is just a financial portfolio with a value that is 1/2 the value of the portfolio containing the asset, okay? So it's not that surprising, okay, if I agree to do reasonings in terms of values more than in terms of quantity, okay? So I also suppose at the last point, okay, that it is possible to short sell the risky asset and to borrow and lend cash. This hypothesis is important here, this one. It is important because it allows you to enter the market, okay, having zero at the beginning. Okay, so you can enter the market and buy or sell, okay, without having any amount of money initially. So, of course, classically, in order to buy something when you don't have cash, okay, you can lend or you can borrow, excuse me, this cash to a bank, okay? And I have explained previously what will be the convention concerning the interest rate, okay? So it's something that you can do. So borrow and lend cash is something that is related to the non-risky asset. I also suppose that it is possible to short sell the risky asset. And here, again, I will do a little parenthesis here concerning a short sell. So I would just want to remind you very quickly what is a short sell. And I have done a little picture here. Okay. So what is a short sell? So when you want to enter the market having nothing, you can borrow cash at the bank, okay, and you will have, okay, a rate related to the interest that you will have to pay. And typically in this situation, what is nice is that if you accept the contract, okay, you know exactly the amount of the interest that you will have to pay later on. Okay, you know this perfectly. The short sell is a mechanism that is a little bit different. So the short sell is intuitively sell something that you don't have. And I will explain, because if I say it this way, okay, it's a little bit strange. So a short sell, it's something between three types of actors. A client C1, a client C2, and a broker. What is a broker? The broker is a professional that has the right to buy or sell assets for clients. And if you have a good broker, it will be a broker with a lot of clients in charge, okay, so of a huge amount of clients. Okay, so what is the idea of the short sell? It is the following one. So suppose that my client C1, okay, wants to do a short sell. So he calls his broker and say, okay, I want to short sell one asset. Okay. The broker, among its other clients, will find a client that I call C2, okay, that accepts to lend this asset, okay, because it has it and he accepts to lend this asset. So C2 give the asset to the broker sell it on the market and gives the amount of money to the client C1. So at the end of the process, it's like, okay, if C1, okay, sells the asset on the market, because at the end of the loop here, he obtained the cash that is exactly the amount relative to the sale of the asset. Okay? Okay, so if I see this principle, okay, I have a natural question, that is, what is the interest of the broker to do this and the interest for C2 to do this? Because, okay, of course, C1 has an interest to do because it has nothing at the beginning and he receives cash, okay? But what is the interest for broker and C2? Okay, so of course, the broker and C2 will receive some fees in order to do this. So some fees that are not that huge, okay, that are small fees in general, okay, but for the broker, it's the way to win money and to do his job, okay, and for the client of type C2 here, at the beginning, it has an asset, okay, at a particular horizon, he doesn't want to do anything with this asset, so he accepts to lend it, okay, to C1 via the broker. He will receive some fees that will allow you, in some sense, to increase the performance of its own portfolio. Okay, so broker and C2 will receive some fees. Okay, so this is the interest for the broker to have the fees, okay? What is the interest for C2 to receive the fees? And also the fact that C2 can stop the process at any time. C2 can stop the process at any time. And what is the end of this process? So it is described by the contract and is the following. If C2 wants to stop, okay, C1 has to buy the asset on the market and give it back to C2 via the broker. Okay, so you have to reimburse C2, not reimburse the cash you have received, but reimburse the asset, okay, related to the amount of cash you have obtained, okay? Okay, so what may be the interest of C1 in this situation? The interest of C1 is that, okay, so at the beginning you have nothing, you do this process, you obtain cash, and at the end you have to reimburse the asset and not the cash. So in particular, okay, if you have a decrease in the price of the asset, C1 will take advantage of this situation. C1 will take advantage of a decrease in the price of the asset, okay, because it has to reimburse, okay, the asset, not the cash. What is more, okay, if the asset that is short sale pays some dividend during the period, of course, okay, C2 will have the difference, okay? As we say in French, okay, you can't have le beurre et l'argent du beurre, okay? Okay, so just a last remark concerning this process, because a priori I have said that here, okay, it's C2 that has the power in some sense, because, okay, C2 can stop when he wants, okay, and, okay, C2 can ask for being reimbursed, okay, in the asset. But in fact, if you have a very good broker, okay, you may be in the following situation. Suppose that C2 wants to stop, okay? So a priori, C1 has to reimburse the asset. But suppose that the broker is a very good broker. That is, the broker is able to find another client of type C2 that I call C2 prime, okay, that accept to lend the asset, okay, the same asset. So the broker will give the asset of C2 prime to C2 in order to close the process with T2, and then the short sale will continue. So if you have a very good broker, in fact, with a lot of clients that will accept to lend the asset, for C1, in fact, this process can never stop, okay, or can stop, okay, only when he wants, okay? And so this process, okay, is a kind of speculation in the decrease of a financial asset if you have a very good broker, okay? So you have this one, okay? Just to remind you what is a short sale. Okay, so let's come back to my slide. So I have explained what is a short sale. Okay, so you have seen that I have used two colors here. color green and red. Okay, so why I have used these two colors? But just to tell you that, in fact, I do these 5 hypotheses. The green one are not that strong, meaning that I can take into account, in fact, in the situation we are going to see together, I can take into account dividends, transaction cost, taxes. Okay, I can of course avoid the continuous time hypothesis if I want to work in discrete time. Why not? Okay, but even if it may be a little bit technically difficult, it's possible to overcome these 3 green hypotheses. Contrary to what happened for the red one, where when you change or when you don't suppose the red hypothesis, you will restrict a lot the set of the financial strategy you are going to be able to do, as we are going to define just after. And it will have some strong consequences of the possibility you will have, okay, to build portfolios, okay, from your 2 assets. Okay, so for the red hypothesis, there are strong one and real one, okay, that allow to enlarge, in fact, the set of the possible financial strategy we are going to define just now. So it's here. Okay, so what I will call a financial strategy in the following. Okay, so I call a financial strategy a progressively measurable process with 2 components, h0t theta of t, with values in r square, such that, okay, so I have a technical things, okay, so for the moment, okay, I don't speak about, okay, let's say this one, that is just integrability condition. I want these 2 stochastic integrals to be well defined. So I have an integrability and 2 integrability conditions here. But mainly, I have a financial strategy defined as a progressively measurable stochastic process. So progressively measurable, it's in order to give sense to these integrals here, okay, and to make them, okay, an adapted process. So it's a process with values in r square, okay, with 2 components, let's say. And we say that we associate to any financial strategy a financial portfolio that contain at time t theta 0t units of non-risky asset and theta t units of risky asset. Okay, so what I call a financial strategy is just something that will say to me that the first component is what I have in my portfolio at time t in terms of non-risky asset, and the second component is what I will have in my portfolio in terms of risky asset. Okay, and I said at the following that the value of such a financial strategy or of such an associated portfolio is given by what? But the value of time t of this strategy is equal to what? The quantity of non-risky asset at time t multiplied by the value of the non-risky asset at time t plus the quantity of risky asset at time t multiplied by the price of the risky asset at time t. Okay? So you have here, okay, a definition that seems to be that natural. Okay, this one. So just a remark concerning, okay, the progressively measurability, the progressive measurability. What is the intuitive meaning of this one? It means that, okay, here it's the quantity of asset I will have in my portfolio at time t. Okay, and this integral or this measurability condition here just mean that at time t, you will take your financial decision, or they will be based only on the financial information available at time t. That is something that is described by calligraphic FT, the filtration of information at time t. Okay, so that's why I impose this measurability condition. If I want to take a financial the decision, I don't want to be in advance with respect to the market. Okay, so that's why I have this measurability condition. And now what I want to say to you is just to show you that in fact in this definition, I have all my previous hypotheses. All these 5 hypotheses are contained in the next definition. So, of course, trading done is continued time because for a financial strategy, I index it by the interval 0 capital T, so it's not a problem. But I also say that, okay, the hypothesis 1, 2, 3, and 5, okay, are also present in the next definition. Where? So just let me remind, so I have no transaction cost nor cost, okay, possible to short sell and to borrow, all assets are perfectly divisible, and the risky asset doesn't pay the dividend. So I said that here, supposing that theta 0t and theta t take values in R, it's a consequence here. So what I have written in red here is a consequence of 2 and 3 from the previous slide. What is 2 and 3? The assets are perfectly divisible. Okay, so I can consider quantities that are not integers. And also the fact that I can short sell the risky asset and I can, okay, borrow cash, implying that I can have negative quantity of asset. When I do a short sell, okay, it's an asset that I have to reimburse. So it's like I have -1 of this asset because I will have to reimburse it later. If I do, okay, if I borrow €1 at the bank, okay, it means that in fact I have -€1 because I will have to reimburse it later on, okay? So here, the fact that my quantities are allowed to belong to R, okay, means that I have allow short sell for this one, and the fact that I am able to borrow and lend cash as I want for theta 0, okay, and the fact that the assets are perfectly divisible allow me to pass from Z to R, okay? So in this little thing here, I have 2 and 3 that are involved. For 1 and 5, it's here. The value is equal to this one from 1 and 5 here. Why? Because, okay, the value of a portfolio is equal to the quantity multiplied by the value if I don't have transaction costs nor taxes, or I will have to subtract this transaction cost or these taxes, and also my risky asset doesn't pay a dividend because, okay, if it pays a dividend, I will have to add it to the value of my portfolio. So I can suppose that the value is quantities multiplied by values only because I have supposed 1 and 5, okay? So just keep in mind, and what I want to make clear here is to see that this definition, in fact, is related to strong financial hypothesis that I will call non-friction hypothesis in the following, okay? So a financial strategy will just be a progressively measurable process with values in R2, okay, representing the quantity of assets I have in my portfolio, the value being the quantities multiplied by the values. And I have these 2 integrability conditions, okay, that I will, okay, speak about, okay, in a few seconds. Okay. I will do a 5-minute break to have a coffee and I come back, okay, in 5 minutes. Okay, so let's come back to our point. Okay, so split my screen. Okay, so we are in the situation where I have defined financial strategy. Financial strategies this way, and insisting on the fact that in this definition, I take into account, okay, the preceding 5 hypotheses that I have called non-friction hypothesis. Okay. And in fact, okay, we are going to use these financial strategies, okay, in order to price and to hedge, okay, our financial product. Okay. So we are going to see in the next slide, okay, a subset of the financial strategies, and we are going to see why I need this hypothesis here, the integrability conditions. It is the set of what I will call the self-financed financial strategies, okay? So let's introduce this definition here. Okay. So a financial strategy is said to be self-financed if the value of the portfolio fulfills the following stochastic differential equation. And we are going to do some comment about this one. Okay. So self-financed mean that we have the following Ito decomposition for the portfolio. Here I have supposed that, okay, ST is an Ito process. So I have here, okay, the Ito decomposition of the risky asset. Here, it's something that I know because I have S0T that is equal to a deterministic process. So D of S0T in this situation is just R exponential RT dt that I can write as R S0T dt because I have something that is deterministic. So first of all, I want to show you that this is a real hypothesis. Why this is a real hypothesis? Because I have defined the value this way. The value, according to my previous hypothesis, is given by this one. So if I want to apply the Ito decomposition here, I have this. Using the linearity. So something that is in general different from theta 0t ds0t plus theta t d of st. If you want, in some sense, okay, my self-finance condition means that I can remove theta 0, so the quantity of asset from the Ito differential here, okay? So this is not true in general, because in general, if I want to compute this and compute this, okay, I can use the integration by part formula, and I don't have these terms, okay? So the self-finance condition is a real condition, okay? So what is the intuitive interpretation of such a condition? In fact, I can interpret this equality here, the one driving the self-finance condition, as the following. The variations here in the value of the portfolio only come from my strategies, okay, that are the quantity I impose in my portfolio, and the variations of the asset themselves. In order to see this, I can write the following. Let me erase this one here. Okay. So I have written here the Ito decomposition in the differential way, but I can also say the following. So if I integrate this one between t and t plus epsilon, I have the following. So I can say that vt plus epsilon h minus vth is equal to what? So to the integral between t and t plus epsilon of theta 0s ds0s plus the integral between t and t plus epsilon theta of s d of ss. And first of all, keep in mind that these integrals are well defined. Why they are well defined? Because I have supposed in the definition of a financial strategy that these stochastic integrals are well defined here, meaning that I have good integrability condition to allow for here this Riemann integral and here the stochastic integral to be well defined, okay? So these integrals are well defined. And if I suppose that epsilon is small here, I can suppose that my theta 0 and my theta, that are the quantities I have in my portfolio, are stable, let's say are constant, okay, during the little time interval t and t plus epsilon. So I can approximate this one by theta 0 t, let's say, and then if I remove it, I have the integral between t and t plus epsilon of this quantity. So I have here S0 t plus epsilon minus S0 t plus theta t st plus epsilon minus st, meaning that, okay, the variation of my portfolio only come from the variations of the assets. Okay, so variation here are derived by the variation in the values of the assets. So intuitively, what is the meaning of a self-financed financial strategy? It's a financial strategy where, okay, that is not necessarily constant over time. If I am constant over time, I am self-financed. Constant over time implies self-finance, but it's not the only condition under which I am self-financed. To be self-financed means that I can reorganize, okay, my portfolio at any time. But if I want to do this, I have to respect at any time a budget constraint. I don't have the right to invest nor to consume. Okay, I don't have the right to invest, so no extra investment, no consumption. For a self-financed financial strategy. Okay, so starting from an initial amount of money, a self-finance strategy is something that you are able to do without extra investment during the investment process and no consumption. Okay, so this is the meaning of self-finance financial strategy. And maybe if I come back to my aging problem, okay, so where at the beginning I have said to you, okay, if I am the seller of a call option, if I want to remove all the risk that is related to the sale of such a call option, okay, I need to find a strategy that will allow me to reproduce at the end exactly the payoff I want to deliver, okay? And of course, if you allow for strategies that are not self-financed, it's very easy to do this because, okay, what you do, okay, you ask at the beginning for a certain amount of money, and at the end, okay, you can complete your investment, okay, investing more money in order to reproduce exactly the portfolio, but it's not what I want to do because, okay, I want only to use my initial investment, that is the price I have asked in order to sell the product, okay, without investing more until the end of the life of the product. Okay, so that's why we are going to focus on self-finance strategy, the one that you are able to do only investing at the beginning and without extra investment during the process nor consumption. Okay, so this is the intuition below self-finance strategy. I repeat a last time, okay, a self-finance financial strategy, it's a strategy, okay, such that at any time you can reorganize your portfolio, but you have to respect at any time a budget constraint, that is, I don't want extra investment nor consumption of the value of your portfolio, okay? And such a strategy may be done, okay, starting from an initial investment and then doing the good, okay, investment strategy. Okay, so I have a first consequence of this definition here. That is the following one. I said that if I have two self-finance financial strategies, so it's the lemma 4.2.1, if I have two self-finance financial strategies that are equal P or more surely at any time, necessarily they are equal up to indistinguishability. So what is the meaning of this one? So you have two, okay, self-finance financial strategy. And I know that, okay, the value of a self-finance strategy from the previous definition is an Ito process, and I have the Ito decomposition, meaning that d of VTH is equal to theta 0t d of S0t plus theta t d of ST. Okay, so this one, so the self-financed condition give me the Ito decomposition of VTH. So in particular, VTH is an Ito process. But what we have seen in the chapter 2, we have seen in the chapter 2 that, okay, the decomposition of an Ito process is unique. So if you have two Ito processes, okay, they will be equal if and only if they have the same Ito decomposition up to indistinguishability. So if you are self-finance, you have this Ito decomposition of the value process, and you see that the quantity of assets appears this way in the Ito decomposition. So if I have two self-finance strategies that are equal, it implies that they have the same Ito decomposition. That is exactly the meaning of what I have written here. Okay, so self-finance strategy gives me the Ito decomposition of VT that is unique up to indistinguishability from chapter 2. And it's a strong result because, okay, a priori, you have two ways to invest. You can invest in the risky asset or in the non-risky asset, okay? And a priori, it should be possible, okay, to have portfolio with different quantities of risky and non-risky that have exactly the same value. And what is the meaning of this lemma 4.2.1? It means that for self-finance strategy, it is not possible. Okay, if I have two self-finance strategy having the same value at any time, P of more surely, necessarily what I have inside that are the related quantities of assets are necessarily equal up to indistinguishability. And it comes from, okay, the unicity of the decomposition of an Ito process. Okay. So something that is important. If two self-finance financial strategy coincide at any dates, then necessarily the composition of the associated portfolios are the same. Okay. So now we are going to express the definition 4.2.2 in an equivalent way using actualized value of the assets. So it's the proposition 4.2.1. that tell you that I am self-financed, that is D of VTH is equal to theta 0t D of S0t plus theta t D of ST, if and only if D of VTH tilde is equal to theta t D of ST tilde. I remind you here that VTH tilde was defined as the beginning of this session as VTH divided by S0t, and that is just VTH divided by exponential RT in my framework here. And so ST tilde is just ST over exponential RT. Okay? So if I have this Ito decomposition, I have this Ito decomposition for the actualized value of my portfolio, of my self-finance portfolio. So just a remark before to do the proof of this result. What is the meaning of this one? This one means that VTH tilde is equal to V0H, so tilde or not, plus the integral between 0 and t of theta s d of ss tilde. And so you see that if this result is true, okay, you see that the value of a self-financed portfolio only depends on two things: of the initial investment here and of the quantity of risky assets. You see that in the actualized value here, you don't have theta 0t. The quantity of non-risky asset, okay, is not present in this expression. And it is that natural, because keep in mind what I have said in terms of intuitive definition of being self-financed. If I am self-financed, it means that at any time, okay, I can reorganize my portfolio, but respecting a budget constraint, meaning that if I move the quantity of risky assets, okay, it will move consequently the quantity of non-risky asset, and I don't have a choice concerning this move because I have to respect the budget constraint. So in fact, I have just one flexibility, that is to change the quantity of risky, and the quantity of non-risky will be a byproduct if I want to respect my budget constraint at any time. And the proposition 4.2.1, okay, is a quantification of such an intuition. Okay, so I have this. So in fact, I repeat that a self-finance strategy, in fact, the actualized value, and so the value of a self-finance financial strategy only depend on the initial investment and on the quantity of risky assets. The quantity of non-risky asset is just a byproduct of the self-finance condition. And in particular, okay, in particular, if you have this, okay, you will be able, so it means that if you are able to compute this term, you have the initial amount of money, you have the quantity of risky assets, and how I will deduce the quantity of non-risky asset, I will deduce the quantity of non-risky asset of, okay, this equation here. I have this one that gives me that theta 0t, the quantity of non-risky asset in a self-finance portfolio, is necessarily given by its actualized value minus the quantity of risky times the actualized value of the risky asset. Okay, so this one is a byproduct of this one, and this one. Okay, so if you want to characterize a self-finance financial strategy, you have only to characterize, okay, the initial investment and the quantity of risky assets. So we are going to do the proof of this one, okay? So I will do one side because the other side is completely equivalent, and do it at home. It's a good exercise. So what I want to prove here, I want to prove that d of VTH equal to equal to theta 0t d S0t plus theta t d of st is equivalent to d of VTH tilde equal to theta t d of st tilde. So I do this side, okay, for the other one, do it at home. So I have the Ito decomposition of d VTH, and I have to deduce the Ito decomposition of d of VTH tilde, okay? I just remarked that VTH tilde is equal to VTH divided by exponential RT. So I can write it this way. So if I want to express d of VTH tilde, it's d of VTH multiplied by exponential minus RT. But from the chapter 2, I can use the integration by part formula for the Ito process. And I am in a situation here where I can use the integration by part formula where one of the two processes is purely deterministic. So in fact, it's the classical integration by part formula. That is, I can write it this way, exponential minus RT d of VTH plus VTH multiplied by d of this one, that is minus R exponential minus RT dt. And I write here plus 0, and the 0 comes from the fact that exponential minus RT is deterministic. So you don't have a term in dBt in the Ito decomposition of this one, okay? So if I continue a little, okay, so I have this hypothesis, that is, I know the Ito decomposition of VTH. So I continue here. I have exponential minus RT of what? Theta 0t ds0t plus theta t d of st. I use my hypothesis plus VTH. Let's write it for this way for the moment, this one. Okay, so I have this one. Okay, I have this one. So what I have here? I have first that ds0t is equal to R exponential RT dt, because S0t is equal to exponential RT. So I have this one. And I have also the fact that the value of my portfolio is given by theta 0t S0t plus theta t st. Okay, so I have this one. So I can simplify a little. What I obtain? So here I obtain what? Okay, I obtain R theta 0t dt plus exponential minus RT d of st plus this term here. So S0t is equal to exponential RT. So I obtain minus R theta 0t dt multiplying this term and this term, because S0t is equal to exponential RT. So this one and this one simplify. So dt here, and it remains minus R exponential minus RT theta of t st dt. So first I see that this term and this term simplify, the term with theta 0t inside, and I obtain something that I can write this way. This is equal to theta of t multiplied by what? By exponential minus RT d of st, okay, okay? And I have what here? Exponential minus RT d of ST. And I have here plus ST d of exponential minus RT. And what I recognize here, using once again the integration by part formula for Ito processes, where one of them is deterministic, I obtain here exactly that this is theta of t d of st exponential r minus rt, that is equal to theta t d of st tilde. So it's exactly what I want to prove, that if I start from the self-finance condition, I prove that I have this Ito decomposition, that is exactly the one I have proved, that was this one, d of VTH tilde, that is equal to theta t d of st tilde. I have this Ito decomposition for VTH tilde, okay? So at home, do the converse, it's exactly the same, okay? So you do the converse at home. So this one at home in order to train in using the integration by part formula, okay? So if I come back to my result, I have proved now that a self-finance financial strategy is characterized by this equation here. So I am self-financed if and only, okay, my Ito decomposition of the actualized value is given by the quantity of risky asset multiplied by d of st tilde. And I repeat once again that it means that a self-finance financial strategy is characterized by its initial amount of investment and the quantity of risky asset, the quantity of non-risky asset being a consequence of, okay, the previous quantities, okay? So this is the definition of something that is self-finance. So just let me have a look on my lectures note. Okay, I don't want to forget anything. Okay, so I think that it's okay. This way, yes. Okay. So now, in the following, we are going to speak about particular financial strategy that are self-financed. Okay, the one that we called arbitrage opportunity. So what is an arbitrage opportunity? So first of all, and it's very important, an arbitrage opportunity is something that is self-financed. So it's a self-financed financial strategy such that three conditions. My initial value is 0 P almost surely. My final value is positive P almost surely. And the probability that my final value is strictly positive is strictly positive. Okay? So I have this. Intuitively, what is the meaning of this one? It means that an arbitrage opportunity is a self-financed financial strategy where, starting from 0, I never lose money because I am always greater than my initial investment, that is nothing, and I have real opportunities of profit. Okay, so this is the definition of an arbitrage opportunity. I start from 0, I never lose, and I have real opportunities of a real profit, that is a profit that is strictly positive. Okay, so this is the definition of an arbitrage opportunity. So several remarks concerning this definition and then a comment on them. First of all, why I impose them to be self-financed? But because I want that an arbitrage opportunity, okay, is something that is not that easy to obtain in some sense. Because of the following. So imagine that, okay, I do the following. I start from 0, okay, I have a portfolio and I start from 0, okay, so I have V0H that is equal to 0. I do nothing until capital T, and at capital T, I inject in my portfolio €1. Why not? Okay. So I invest here So I start from nothing and I just at the end put €1 on the table and say, okay, is it an arbitrage opportunity? But no, it's not an arbitrage opportunity, this one. Because what I have done, okay, I start from zero. At the end, I am always strictly positive, but what I have done to be strictly positive at the end, I have invested €1 at the end. And keep in mind that what I have called a self-finance strategy is something that once you have invested at the beginning, you don't have the right to consume nor to invest more during the investment process. The only possibility you have is to change the composition of your portfolio, respecting at any time the budget constraint. And here at the end, if I invest €1 at the end, of course, you won't respect the budget constraint at capital T, because at capital T, you have put €1 on the table. So what I have, try to explain here, this one is not an arbitrage opportunity, because I invest at the end. Okay, so my definition of an arbitrage opportunity is stronger because I want it to be, first of all, self-financed. Okay. So second remark, that is the one that is right in here. At the beginning of the session, I have said nothing, okay? In order to define my market in continuous time, I start with a probability space omega AP. And I have tried to explain to you intuitively what are each component of this probability space. And in particular, I have said to you that capital T, that I call the historical probability, is not something that I know in practice. It's not something that I know in practice. Okay, I need too much information in order to be able to have access to this historical probability that is, let's say, the true probability of the market. But here you see that you have a definition that strongly depends on P. You have P here, you have P here, so you have P everywhere, in fact, here in my definition. So you have a definition that depends on something that I don't know, something that is not that good. But in fact, not that much. Because if you consider a probability Q equivalent to P, I remind you that Q equivalent to P means that Q of A is equal to 0 is equivalent to P of A equal to 0. Okay? So they have the same set with proba 0. So they have the same set of proba 1. And they have the same set of probability that are strictly positive, of course. And so, in fact, in my definition, what is these conditions here? It means that the probability P that this one is 0 is 1. But if the probability that this one is 0 is 1, necessarily the probability Q that this one is 0 will be 1. In the same way, if the probability P that this one is greater than 0 is 1, then the probability Q that this one is positive will be also 1. And in the same way, if this probability P here is strictly positive, it will be the same, if I put Q instead of P. So it means that in my definition, if I replace P here and here by Q, I change nothing to my definition if I start with a Q that is equivalent to P in the sense of probabilities. So this definition here, in fact, doesn't depend that much on capital P. It depends on, the class of equivalence, if you want, of P with respect to the equivalence between probability. If I change Q into an equivalent probability, I change nothing in my definition, something that is really important because, as I have already said, P is not known in general, so if you have a definition that depends too much on P, you have something that is a little bit strange, so I am independent of such a choice up to equivalence between probabilities. Okay? So let me show you an example of such an arbitrage opportunity, a very, very basic one. Example of an arbitrage opportunity. So suppose that you have one product with one quotation in Europe and one quotation in the United States. Okay, so you have a product, a single product, so one product, one asset, okay, one asset. In the US, its value is, let's say, $1.1, okay? And in Europe, the same product can be bought or sold at €1. And I suppose that €1 is equal to $1 because I don't want to consider, okay, the relation between the two monies. Okay. I said that you have here, okay, a canonical example of what is an arbitrage opportunity. So you have one product that you can bought or sold, okay, at two different prices on two different marketplaces. So how to build an arbitrage opportunity according to my definition? So first of all, an arbitrage opportunity is something that starts from zero. So what I will do to start from zero, I will short sell in US and buy in Europe to reimburse my short sell. And if I do this, what I will do a profit, because if I short sell the asset in the US, I obtain 1.1, and investing 1, I am able to buy the asset in Europe in order to reimburse it in the US. And I obtain plus 0.1 as a profit. So you have here an example of an arbitrage opportunity. Okay, you start from zero. So of course you have something that is self-financed because you don't have something that is dynamic here. I short sell and then I reimburse. Okay, so you can't be more self-financed than this one. Okay, you start from zero because you do your strategy short selling an asset without having anything at the beginning. Okay, and just buy in Europe to reimburse. And at the end, you have something that is always strictly positive. So you have here an example of arbitrage opportunity. But let's continue this example. What happened in real life, okay, if such a situation exists? But the idea is that what you will do, if you are a rational investor, if you detect such a situation, of course, you will take profit. Okay, you will take profit doing short sell in the US and then buying in Europe, okay, in order to reimburse your short sell and do the profit. But if you do short sell in the US and if you buy too much in Europe, okay, what happened? But then the price here will increase by the law of supply and demand because you will have, okay, a great demand in Europe in order to buy. So the price will increase here. In the same way, in the symmetric way, the price will decrease. And so at one time, okay, I will have a stabilization at the same price. So I see that such a particular situation, if I have investors that are able to take profit, okay, using this situation, they will make it disappear, okay? And in general, in a good financial market, we say that we don't want arbitrage opportunities. So it doesn't mean that they don't exist, okay, as I have explained to you in my little example, but we justify this strong assumption, okay, the fact that I don't have arbitrage hypothesis, by the fact that if there exist, there are, okay, practitioners on the market that are paid to detect them, and if they detect them, they make it or they make them disappear, okay? So for most of people, okay, you won't see such a possibility, okay, in the market because it will disappear immediately if the market is well organized. So in what follows, and in most of financial models, okay, using mathematics, okay, you don't want arbitrage opportunities. So such strategies are in general not allowed because, okay, in some sense, they are miracle strategy. I start from zero, I never lose, and at the end, I have real opportunities of profits. Okay, no. If you want to win, the price to pay in a good market is, okay, to have the possibility to lose. If you don't have the possibility to lose, okay, you have a strategy that is that nice for sure, okay, but that is a miracle strategy, okay, that don't have to exist in the market, okay. So in general, okay, we will suppose or we will prove that a financial market doesn't have, okay, arbitrage opportunities, okay. So to conclude this little part, if I want to prove that something is not an arbitrage opportunity, or if I want to prove that an arbitrage opportunity doesn't exist, what can I do? I start from a self-finance financial strategy that starts from zero and that is always positive. And to prove that it is not an arbitrage opportunity, I prove that the last condition is not fulfilled. That is, I just prove that this one can't occur. That is, VTH is always equal to zero. So if I ask you to prove that on a financial market, it doesn't exist an arbitrage opportunity, you will start with a self-finance financial strategy starting from zero that is always positive at the end, and prove it that if it fulfills this condition, it is necessarily equal to zero at the end, okay? So it's the way to do. Okay. So I have defined arbitrage opportunities and explained that in general, we don't want them on a good financial market, and typically because we don't want to have this kind of situation. If I have one product, I want to have one price, one product, one price, okay? If I have arbitrage opportunity, okay, intuitively, it means that I have such type of situations, okay, that may be more complex in reality, okay, but that are not that good, okay? It's a kind of failure in the market organization. Just a last remark concerning this, okay? So when you see this kind of situation, you say, okay, it's very easy to do a profit with this situation, but be careful. It's a real job to be able to take profit, okay, of this kind of situation because of two arguments. First, you need to be able to short sell, okay? That is to sell something that you don't have. And in general, if you want to be able to do this, okay, but you need to be a good practitioner. Okay, for individual persons, often it is forbidden to do this because you will have a possibility to invest without having nothing. And so we have a problem of solvability for sure. Okay, so in general, practitioners are able to do this, okay, first. And secondly, what happened in real life? In real life, if you do a short sell and if you buy the asset in Europe, you have to pay transaction costs. And in general, okay, the little difference between the prices of the two assets are not enough to absorb, okay, the transaction cost. If you want to absorb them, you need to be able to invest a big amount of money at the beginning, something that you're not able to do in general if you work as an individual, okay? A practitioner can do this because it has the possibility to invest more and more money in order to take advantage of small failure in the market. Okay. So I have this. So now I will more or less finish. Yes. Yes, more or less finish the definition of this course. Okay. By the notion of equivalent martingale measure and the link with the absence of arbitrage opportunity. So first, the definition. What is an equivalent martingale measure? An equivalent martingale measure is a probability P star that is equivalent to P. Okay, so first of all, I have a probability that is equivalent to P. They have the same negligible sets. In other words, they have the same set with proba 0, under which the actualized value of the risky asset is a martingale under P star. Okay, an equivalent martingale measure is a probability P star equivalent to P that make ST tilde a martingale under P star. So a priori, there are no reason that ST tilde is a martingale under P, but as a definition, I impose it to be possible for an equivalent martingale measure. Okay, so you will see in the lecture notes that there is in fact a deep link between the notion of equivalent martingale measure and the notion of absence of arbitrage opportunities. So if you have followed my course of arbitrage, okay, I know that it's the case for some of you, you have seen that in the discrete time framework we have done together, we have a very, very nice result that is following. I have no arbitrage opportunities if and only if there exists an equivalent martingale measure. So this very nice result is possible in discrete time. Okay, and it's the perfect result in some sense. When I'm in continuous time, it's not possible to have such a general result. It's a little bit more complicated than this. But in fact, there is a big link between these two notions. In particular, and it's what we are going to see just after, we are going to see that if there exists an equivalent martingale measure, we can say that we have absence of arbitrage opportunity, but not for all the self-finance financial strategy, but only for particular self-finance financial strategy that we call admissible financial strategies. And for what we are going to do in the chapter 5, to have the absence of arbitrage opportunity among these kind of strategies will be enough for us. So we don't have a nice, very, very general result in the continuous time framework, but some links, some deep links between, okay? It's nice because you have a notion that is a purely financial notion, arbitrage opportunities. I don't want miracle strategy in the market. And a notion that is purely probabilistic, the one of equivalent martingale measure, a probability equivalent to P that make the actualized value of the risky asset a martingale under. Okay, so it's what we are going to see very easily, and it's not because what we are going to see here, it's technically very simple to do. So just be careful in the definition 4.2.5 because there is a misprint here. So I have a problem with my LaTeX here. I don't know why. So I repeat, an equivalent martingale measure is a probability equivalent to P that make the actualized value of the risky asset a martingale. Okay, and I define a particular set of self-finance financial strategy related to an equivalent martingale measure. I said that a financial strategy is P star admissible if it is first self-financed. Once again, and from now on, we are going to work only with self-finance financial strategy. And if the actualized value of the associated portfolio, so that it's here that I have a misprint, okay? So the actualized value is VTH tilde, okay? I want the actualized value of any portfolio associated with a P star admissible financial strategy is a martingale under P star. Okay, so it's a set of particular strategies, the one where, okay, the actualized value is also a martingale under P star. And the nice result is that, okay, if I work with this financial strategy, I have no arbitrage opportunities among them. It's what we are going to prove. So no arbitrage opportunities among P star admissible financial strategy. So let's do the proof of this proposition here. So if I am P star admissible, it means that I am self-finance plus VTH tilde is a martingale under P star. And what we want to prove? We want to prove that such a strategy can't be an arbitrage opportunity. Okay, so I want to prove that it's not possible to have an arbitrage opportunity, okay, among this set of strategy. So as I have explained previously, okay, let's consider the following. So let, okay, H be a P star admissible strategy such that, but suppose that you start from 0 and that your final value is always positive. And if I want to prove that I don't have arbitrage opportunities, I have to prove that, in fact, the probability that VTH is strictly positive, I want to prove it to be equal to 0. Okay, so why I have this? So first of all, keep in mind that P star and P are equivalent. And keep in mind that in the definition of the arbitrage opportunity I have given to you here, I have said that, okay, the definition doesn't change if I change P into an equivalent probability. So meaning that in my proof here, what can I do? I can replace P by P star and P by P star here and here, and it changes nothing. And why it's better to work with P star? Because I know that HT is P star admissible. That is VTH tilde is a martingale under P star. So I prefer to work with P star because I have some properties under P star. Okay? And what happened in this situation? So you are going to see that it is very simple. So I want to prove that this one is 0. To prove that it is 0, we are going to consider the expectation under P star of VTH tilde. What is this one? But a P star admissible financial strategy is something that is a martingale under P star. And keep in mind that a martingale is something that is constant in expectation. So here you have this one that is equal to the initial value. That is V0H tilde. Why? Because, okay, if I am a martingale under P star here, I have this one. I am constant in expectation. But I have done the hypothesis that this one is 0 because V0H is 0. And then what can I say about what I have inside here? I have VTH that is positive, and so I have something that is positive here. So you are in the situation where you have something that is positive with an expectation equal to 0. From the course of probability, it means that the probability P star that VTH tilde is equal to 0, this probability is equal to 1. And so, since P star and P are equivalent, that the probability that VTH tilde is equal to 0 is equal to 1. So you have proved that you have this. It's not possible for you to be strictly positive with a proba that is strictly positive because you are zero, let's say, everywhere in the sense of the probability P. So I have proved very basically, just using this little martingale argument here, that if you are P star admissible, okay, you can't be an arbitrage opportunity. And it's something that we are going to use in the chapter 5. So let me conclude with the last definition, that is the definition of a contingent claim. And I will explain just after, okay, what will be the study plan, okay, of the chapter 5. So what is a contingent claim? A contingent claim are financial assets whose prices depend on the values of the other assets. So other asset, okay, in my market, I have the risky and unrisky. So let's say, depending on the risky one. In the framework we are going to work with, okay, I will consider it to be an F capital T measurable random variable, fulfilling some technical interoperability condition that I will detail in the chapter 5 because they depend on the model we work with, okay? So let me give you examples, okay, to underline this. So for example, if you have this, according to my definition, you have a contingent claim. If you take this, according to my definition, you have a contingent claim. If I take this, according to my definition, you have a contingent claim. If I take this, according to my definition, I have a contingent claim. What I have here? Here I have a classical call option. I have a classical put option. I have here a classical, okay, ASEAN option. It's an option on mean, okay, of European type, but on the mean. Here, okay, you have an option on maximum that is of the European type, okay, and all these products that are in fact made on the risky asset are what I call contingent claims, okay? They are just F capital T measurable random variable. And for you, and to give you an intuition, you have to think this definition as the definition of the payoff, okay? It's the set of all the payoffs. So a contingent claim will be the payoff of a European type option, okay? So now what I will do in the next chapter after the holidays, okay, once I have presented all these basic notions. Step 1. For the moment, I don't have precise what is the ITO process below the risky asset. If I want to do things in a more practical way, I need to fix it, okay? If I want to fix it, I have two constraints. I want to have a very, very nice ITO process in order to be very close to the reality of the market, okay? But I also want an ITO process that is sufficiently simple in order to be operational, meaning that to have a model, okay, that is precise, but I want to be able to exploit it, okay, without too much technical problems. And I will come back to that later. So I will have to precise the dynamic of the asset. And unfortunately, and since this course is an introduction, I will be more motivated by the one than by the two, by the two than by the one in this course, okay? In this course, what we are going to take as a framework, okay, will be the framework of the Black-Scholes model with a very basic ITO process in order to represent the dynamic of the asset. But it's possible to extend, but this course is an introduction, so we are going to restrict themselves to this situation, okay? So I will focus more on this one. Because with this one, okay, so it will be Black-Scholes for me, I will be able to present you all the key ideas, okay, of finance in continuous time without too much technical difficulties. So it's the first step, okay? start with a model. Second step, study the properties of the model. Typically, okay, I don't want arbitrage opportunities. So I don't want arbitrage opportunities, so I have to check that I don't have arbitrage opportunity. You will see that in the second chapter, in the last chapter of this course, I will prove this in the Black-Scholes model using the Girsanov theorem. Okay, so study the properties of the model, Girsanov theorem. Propose a price for a large family of contingent claims. So we are in the situation where we have two assets, the non-risky and the risky. Assets that we are, let's say, able to buy on an organized market. My objective in this course is from this asset to build more complex financial products that I have called contingent claim. And I want to give them a price because they are not necessarily, okay, they don't have necessarily a quotation on an organized market because they are made from my initial market, okay? So I want to be able to price them, okay, in a clever and rational way, okay? And by obtain the price, I say that I want to have nice formula if it's possible, okay? Depending on the parameters of the model that I am able to obtain from, at the very least, statistical point of view, okay? Or if I don't have very, very nice closed form expression, okay, I need to want to have expression, theoretical formula that I am able to approximate using classical approximation numerical methods, like, okay, the one coming from partial differential equation or Monte Carlo simulations, okay? So I want to propose a price for a large family of contingent claims. And you will see that it will be possible, okay, under the no arbitrage hypothesis to do the job for some assets. And in the Black-Scholes model, it will be possible to prove that the family of assets for which I am able to do this is large because I have the martingale representation theorem. So the martingale representation theorem will tell me that the large family of contingent claims is in fact all the contingent claims under integrability conditions. So the martingale representation theorem will give us the opportunity to do this in the Black-Scholes model for a huge family of models. Okay, so it is my step 3. Step 4, okay, propose financial strategy to reduce all risks due to the random fluctuation of the underlying. So keep in mind my initial example of selling a call option, okay, even if I do a very good pricing, okay, I have an exposure toward risk that may be huge if I have an increase in the value of the risky asset. I want to reduce as possible this risk, and if it's possible, to make it equal to 0. To make it equal to 0 will just mean that I will be able to reproduce my contingent claim using my initial price associated with a self-financed financial strategy in order to be able to deliver the product I have sold, okay, independently of the random fluctuation of my financial asset, okay? So this is the problem of the hedging, okay? And once again, this one will be related to, okay, the martingale representation theorem. And finally, at the end, okay, if I had time, we're going to discuss, okay, what happened for the Black-Scholes model if I confront it to the reality. So reality of what? The reality of the financial markets, because, okay, several contingent claims are quoted, in fact, on derivative markets, okay? For example, the case of the put and the call options, okay? So I can compare the prices given by the model to the prices given by the market, okay? To see if there is a big difference. And I have also, a priori, to compare my model to other models to say, okay, I have a model, I have made a choice that will be a little bit frustrating in the chapter 5 because it's a very classical and basic model, but it's not that perfect and I can improve it, okay, if I complexify it a little using more and more mathematical tools, okay. So I won't spend too much time on this last part, okay, but I will give you some comments, okay, and some opportunities in order to see how to develop the Black-Scholes model in order to make it a little bit more realistic than it was. Okay, so this chapter 4 is finished. Okay, see you after the Christmas holidays for the chapter 5 that I will do, okay, in the 2 first sessions after the holidays. So see you and bye-bye.